tax activities and pension schemes. Okay, share, sorry. All right. So what is tax activities and pension schemes? Tax activities are basically tax that you need to pay. You can get into a really big problem if you don't pay your tax properly, and make sure that the different types of taxes are processed. In each country, the taxes differ. So you have, if you take a country like USA, you have the federal tax, the state tax, and things like that. Each state will have their own taxes. Okay, so and each company would have their different taxes, and what we call tax brackets are there. So if you are a small business owner, there'll be a different tax. If you're a multinational company, different taxes. If you are bringing in some countries, if you're bringing in dollars, you're going to get less taxed, and different ways and different services will have different tax schemes. But what the most important part of a finance division is to make sure that all these taxes are filed. What we call paying the tax is what we call filing the taxes. And at the same time, you need to know that you need to make sure they're paid on time, and if it is not, and if there are any issues to be addressed, because in some countries not paying tax is a criminal offense also. So make sure one of the main functions of a finance department is to make sure that you're empowered with you're okay, and you are knowledgeable with the tax system of the country. And if you are importing or exporting goods, you need to know what is the tax processes and everything when it comes to all the other countries that you're getting your goods and services from. Other thing is what we call pensions. Pension schemes are what we call EPF ETFs. EPF is Employee Providence Fund. And if you are a government employee, in some countries we call it pension. In America, what we call 401k, or what we call Social Security. If you, Dan, what is this pension scheme you get in your country?
Yes, madam.
What is the pension scheme you get in your country?
Provident fund, madam.
Providence Fund.
PF.
Okay,
Yes, ma'am.
PF, just Providence Fund.
Yes,
Okay,
yes.
thank you so much, Dan. So Providence
Thank
Fund.
you.
So make sure that you pay, because what happens is that the employee, what they do is they cut a little bit of the salary and they give an additional amount from the company, and they put it away in these departments of, say, Employee Providence Fund Department, Providence Fund Department, Labor Department. Then you have the 401k, which is basically, if I'm not mistaken, if you have to deposit it in a bank, and it will accumulate interest. And this is so that one day when the employee cannot work anymore, they have something to lean on. They're financially what we call safe. Okay, so that is very important. Again, if you don't follow suit, in many countries it's considered a fraud, that you can, if the companies can be in a lot of trouble if these are not um, done properly. Okay, if it's not done properly, then what happens is that they can really go into uh, you know criminal offenses, bankruptcy, things like that, because the government will take action, because you're cutting somebody's salary, and telling them that it's going to be kept aside so that they will add more value to it. This is a benefit that you give to your employees. So it's very important that as a finance as the finance department, that these pension schemes and taxes are really looked into and done on time, because in some countries you have things like rules and regulations where you will get penalty if you don't put it properly on time and things like that. Then there are areas where you are given travel bans if you're part of the director board of the company. So make sure that the finance division really is on top of the tax and the pension schemes. Okay. Then we have payrolls, claim processing, and automation. Payroll is basically the payment, okay? The payment that you don't need to go deep into payroll. You need to go deep into payroll as finances, but it's very basic to understand. That's what I mean by that. Payroll is what you get paid every time you get to your company. But again, each company will have your payment in different ways. So some will have hourly rate, some will have hourly rate, some will have what we call it. So hourly rate will have, they would have broken your payments into two segments. Sometimes they will have pay you twice a month, sometimes weekly, sometimes they will have what we call, so in Sri Lanka, we have the payments, our salaries are broken into two, where one segment is where the taxes are cut from and where your EPFs are cut from, things like that. And then the other ones we go as allowances. Okay, so that's very important. Each country will have their own way of method of payment, but payroll is very important, because if you don't pay your employees, they're not going to work for you. They don't work for you means, well, you're really not going to get your work. You're not going to make a profit after all. Okay. Then who can quickly tell me what is claim processing? Aubrey, are you able to tell me what claim processing is all about? Majanat, I hope I pronounced your name, and if I didn't, I'm really sorry about it. Marvik? Marjorie, there you go. Would you like to tell me what a claim processing is about? Okay, I'll explain what claim processing is about. Okay, so claim processing is where you're going to make sure. So claiming is that you're going to say you're going to have things like transport. They are not going to give you allowance for transport. They're going to say, we are going to reimburse your transport. So you're going to take all your bus tickets, train tickets, your petrol receipts and everything, and you're going to submit it as a document to the finance department. And they are going to make sure that it is authentic. Okay, they are going to, the finance department is going to make sure and it's authentic. And on top of that, most finance departments will have basically a leverage or a bar on how much of claims you can claim per month. Because if not, people will claim from all over the place. Okay, so they will assess as how much of it is going to be needed, and that's as much as you can claim. Then you have medical claims. If you have insurance and if the company has given you insurance and you have gone to the doctors because you are not well, or say if you have family insurance, say your child or your husband or someone that who's covered by the insurance goes, then you're going to take the receipts and you're going to submit it to the finance department and say, look, this is what I'm going to claim. Again, they're going to assess and see whether it is going to be true or not. Is it right or not? If it's a fraud or not? Because these in the finance department is where most amount, unfortunately, a lot of fraud also happens in these areas. Claiming bonuses, not bonus, sorry, that was a mistake. Claiming and allowances and things like that is where a lot of fraud can happen, purchasing and things like that. So because of that, the finance department really needs to go in and see, yes, is this right or is this wrong? And if it is true, they will reimburse the money. In allowances, what happens is they give you money and you have to manage the payment. Whereas claiming is you spend the money and you then tell the finance department, here it is. I have spent the money because, and this is what is owed to me, and they need to make sure they pay up. Okay, so sometimes when you have overseas travel, again, claim processing. Automation is basically what is, nowadays, so many of these are through softwares. GIS claims. Can I know what GIS claim is all about?
Group insurance, madam.
Group insurance. Absolutely. Absolutely. Thank you for sharing that. Okay.
That also That also implement in Bhutan, madam.
Absolutely. So it's implemented in Bhutan.
Yes,
Definitely.
ma'am.
Right. Thanks, Dan. So basically, again, all that group insurance is very important. And these are
Yes.
an automation is basically where you automate everything. The payroll, all these things are going to be automated. And the moment you enter the time you have come and the time you have logged out and your sick leave and that leave and everything, they just enter it and they will tell you exactly how much you're going to pay. So these automation softwares basically will even deduct your EPFs and what we have something called ETF or 401k or social security, taxes, everything is deducted so that you need less human activities and there's less area for error. Okay. And then we have regulatory requirements. That is where regulatory really means is that the government's rules and regulations that has been implemented or any other rules and regulations that has been implemented for that particular company you work for. Okay, so if you are in, say, accounting or law firm, you are bounded by the bar association of your country. If you are in an accountant firm, then you have to adhere by the rules and regulations of the, I think, the Chartered Accounts Association or something like that. You have different regulatory requirements that are there that needs to be adhered to. Okay. And its finance is no difference. You need to adhere to the rules and regulations that is required by the finance, different, finance associate groups, rules, regulations come. Then you need to adhere to the rules and regulations implemented by the country. Then you need to adhere to the rules and regulations that you're sending your goods to and receiving your goods if it's import or export. Then you need to really go by the rules and regulations of whatever the kind of goods and services you manufacture, okay, or create or give. Now we come to a very interesting part. We come to the role of the finance manager. So we are talking about managing finance, what is finance, what everything to do with finance, all these things. But really, what is the role of the finance manager? First and foremost, the person who kind of makes sure that all of these functions, that he keeps the balance between the CEOs, the COOs, and the heads of other department, and make sure that this whole company's financially prosper and makes proper decisions fall onto the finance manager. So we have what we call the chief financial executive, or chief financial officer, all these things, but they are basically people who make sure, who are in executive positions, who make sure that the finance department runs properly, makes the correct decisions, that the inflows and outflows are properly done, and that fraud is less, the taxes are paid, the bonuses are given, the dividends is paid, everything is overlooked by these financial managers. Okay, so what are their responsibilities? One of it is raising funds. Number one responsibility of a finance manager is to make sure you raise funds. Okay, they are the ones who are going to make sure that the cost, they're going to they will argue that the cost is not the cost, the price, the sales price is as much as possible that you can sell a good. It's not going to be unreasonably high, then you're not going to be able to sell a good. But at the same time, that they're going to make sure that the funds come in. How do you get the funds in? Okay, they are going to make sure, they're going to decide whether the ratio between the debt and equity, okay, it is important to and maintain the balance. They're going to make sure the balance is there between how much is your debt and how much is your spending, and how much are you earning, how much are you, what is your future earning. Everything is about raising funds. You're going to make sure, one of the main roles of financial managers is to make sure that you raise the funds so that The company is going to make a profit and then make an earning and then make sure that it's doing well and it becomes big. Allocation of funds. So when you earn the funds, sometimes you need to allocate the funds. You need to, like we were talking about how we're going to spend the money, right? Remember, we were just talking about it. What about what are the investments? What are the things? What do we need to make the goods? Or what are we going to need? What are the products we need? What are the different things that is required? What are the services that are required? This all requires funds. Okay, and how do you allocate the funds? You're going to look at, is it worth it? It's up to the financial manager. He's going to analyze it. He's going to do a cost analysis. He's going to do a profit analysis. He's going to use all these lovely formulas and make sure that when he allocates a fund, that it's going to bring. So if he allocates 1 million dollars, okay, let's put $100,000 into a machine, that this machine is going to bring in millions and millions of dollars back. Okay, and he'll have an exact number in mind. And how much should it be, how much should he spend to bring it, cover the cost and make a profit? All that has to be done, and that is about allocating the funds. Okay, so to allocate the funds, the best possible manner is, you need to know the firm, how its growth capacity is. If the growth capacity is small, that is, if your market is not going to grow beyond a certain point, you have to be able to see how are the other ways you're going to make your revenue. Things like that has to be really thought of. Okay, you need to go and assess your assets. You need to know what are they long term and whether they're long term or short term. When we're talking about assets, we have to always talk about the depreciation value, which I keep talking about when it comes to assets, because most assets have something called the depreciation value, where each asset loses its value as time goes by. So when you spend a lot of money on it, but it loses my value, you're losing, it's considered it's going away from you, and whereas away from the company. So then you need to know, how are you going to earn through it? Okay, and those are all important decisions made by the finance manager. Then profit planning. Now we have the cost, we have the, we are really going to find the funds, and now we're going to, it's up to him, how do you plan the profit? Okay, so profit earning is one of the prime functions. Okay, so profit is derived from factors such as pricing, competition, state of the economy. So if you are in a country or a area that it is recession, for example, so then how do you plan your profit around that? Okay, or if you are in a growth area, how are you going to plan your profit around that? How are you going to price it so people would buy it, but you're making the maximum? So those are very critical decisions. So you have your cost, you need to make sure you price it so that people would actually buy it. So what is the maximum price you can go? And when you price it, they are also thinking of, can we give a discount later? Can we do so many other things? Those are the roles of financial managers. Okay, now I'm going to ask you, what is understanding capital markets? Why should a financial manager understand the capital market? What is so important about that? Anyone? Christina? Um, Irene, would you like to say why a financial manager should understand the capital market? Riza, do you want to say why my financial manager should understand the capital market? Chanel, Sorelia? Soralia? Okay. So a capital market is where the stock exchange happens, the sales of, stocks, cab, bonds, all these things happen. So this is very important, especially for a bigger company, even a small company, but especially for big companies, it's very important because that's where you're going to earn money through, where the stocks are sold out. You're really going to earn when more people buy your stock. At the same time, it gives you, there's so much of financial benefits based on it. So because of that, understanding the capital market, making sure when the dividend should be paid for the stock market, how many stocks are you going to release, that has to be thought of. So many things that has to be thought of when it comes to the financial manager, when it comes to the capital market. And capital markets, again, depends on the company, whether you're going to really look into it a lot or not. But if you are definitely a multinational company or a bigger company, or you're going to go public, what we call issue stocks and go into the stock market, then you need to really have a finance manager who's going to understand these whole workings of the capital market. Okay. Then we go into financial goals, profit and wealth. Okay, profit, isn't profit wealth? Who can tell me what is the difference between profit and wealth when it comes to finances? Isn't profit what we call wealth, or is there a difference between profit and wealth? Glory? Joyce? Marjorie?
Oh, profit. For my own understanding, profits like is the return of income,
Mm-hmm.
and then wealth is your savings in your bank. That's how I
Absolutely.
understand. Is
Very
it
good
not
way of
correct?
starting. You are correct in a very
Yeah,
personal way, Marjorie. You said it
yeah,
absolutely correct. Thank you so much.
yeah. Thank you.
And if you apply that theory, Marjorie, what you just said, to the business market, okay, and that's exactly what it is. Okay. So profit is what you talk about, money, gaining your cash inflows, cash outflows. Those are all profits. Wealth is about gaining more making the company bigger, making sure there is more stockholders, that the stockholders gain wealth so they are happier and they are going to invest more and things like that. Okay. It is the bigger picture is the wealth of a company, and the profit is where we are talking about the money that comes in and the money that goes out. Okay, so the basic difference of profit and more wealth is what, Marjorie. So think of it, if you get stuck in finance, for example, think of it more personal and uh, kind of make it bigger and implement that in a global or in a bigger setting. And that's what it is for most of the time, not all the time. Okay. It's for when it comes to the uh, business area. So here, the basic thing you have to know for today is that profit is when it comes to money, inflow money, outflow money. How, if the inflow is more than outflow of the money or the cash or all that, is profit. When you maximize the value of the company and you grow your stockholders and you really your dividends become bigger, the stock market, your stock prices goes up, when you add value to your entire company, is where the wealth, what we call the business wealth or the financial wealth, okay, the wealth of the company. Okay, see, basically that's what it is. Okay, so here the main responsibility of the firm is to carry out the business and manufacturing goods and services and selling them. That's profit. But at the same time, when, sorry about that, when the company grows, okay, and it becomes very efficient and it's goes global and demand is more, the value of it increases, then we talk about it as the wealth. Okay, so here you get two ways to increase the profit margin, which is due to lower cost, and the other thing is basically the firm can reduce the final price. So that's how the profit is done. Okay, so one is reduce the cost, uh, and the other one is you reduce the the selling price with the hope of selling more products. Okay, so these are different financial structures that are there, that the finance manager along with the team, along with all the rest of most of the other managers, get together and see what is the best way. So if you reduce a little bit of the price, and then you kind of sell it, and you sell more products, then you'll earn a bigger profit, right? And then when you earn a bigger profit and your company becomes bigger and there's more benefit, and the stockholders are happier, then you increase the wealth. If not, you have to reduce the price. Then what you do is you kind of see where you can reduce the price, and then by reducing the price, you increase the profit margins, because your selling price, your cost is significantly lower than your selling price. Okay, so these are different ways you're going to think about when it comes to finance goals. So here, profit maximization criticism. Who can tell me what is criticism? Why is people criticizing profit maximization? Why is profit maximization being criticized? Profit maximization is criticized for many reasons. Okay, they argue that profit maximization has brought upon many disparities amongst consumers and manufacturers. Okay, so in case the perfect competition is, it may appear as a legitimate and reward for efforts, but the case of imperfect competition, that is, it's not been, there is no proper competition. Okay, it is basically what they're trying to say here is that one company would be dominating it. Okay, so they might even have in different names one company, but they are in different names, so but one company is dominating the whole thing. Another one for criticism is where a single producer, okay, what we call a monopoly, you are the only one who's doing, so you can charge any amount of money because you can't buy this product from anywhere else. Okay, so what we call a monopoly, that is your single person dominating it. Okay, or where they come up, one of the standard reasons where profit maximization criticism is, they create a need that is not there anymore. Okay, so one of the main criticisms for profit maximization, a good example is children's breakfast cereal industry. Okay, a lot of people criticize, a lot of health and health gurus or health uh, advocates and doctors really criticize and argue and fight against this children's cereal products, because if you see a cereal product, they have created such a hype about the cereal having milk, so much of glasses of milk, it's having so much calcium, it is like this. But basically, they're not emphasizing the amount of sugar and other artificial stuff that goes into the cereal, right? They are creating, so the whole cereal industry, the children's cereal industry, it's not as much the adults, but mainly the children's cereal industry is is a very good example of profit maximization, and where there's a lot of criticism in it, is that they have created this hype about how wonderful these sugary cereals are, but in reality, it's not very healthy for the children. Okay, but the sales have created, the sales marketing and the financial finance together has created this persona that its cereal is so good that everyone should have it. Okay, that's one of the criticisms. So they will create, so the criticism is that where they create a product that someone does not really need, but make it look like you really, 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 really need it. Some creams are like that. Some household products are like that. Okay. Another, so tempting packages again. See, if you take the children's cereal packets, they look so fun. They have even games on it, right? So because of that, there's a lot of criticism going on in this area. Okay. So then here, government play another criticism is an important role in curbing the practices of charging extraordinarily high prices. Okay, so there is what we call a price ceiling. Sometimes the government puts a price ceiling on a good, because if not, people on a good that is required by the people. People by the general population. So what the government does is they really put a ceiling on it, but sometimes it's too low and they don't earn enough. So what happens is that it happened to a gas company, cooking gas company. It's a literal, the I can't remember the name of the gas, but basically what they did was the government put a ceiling and the ceiling was too low and they couldn't make a profit and it closed down. So there are a lot of situations where the profit maximizing really plays a role, and if you don't do it properly, there could be a lot of criticism. The company could suffer. All these things could happen. Okay, so role of finance function in the corporations. Who can tell me what the finance function is all about? Okay, what is the function of finance? Anyone? What is finance function? So in a nutshell, finance function is all that is needed to make the finance of the company function. So you're going to talk about how the profits are, how are you going to invest, what are the decisions that are going to be made, what is the outcome of it. All these fall in the finance function. Okay, so here in a nutshell, it says profit, asset value, debt, equity, and every other measure that comes in is basically the role of the finance function. Okay, its measures are indicative of how well the corporate is doing financially. So they will first have this whole system. So they will have this finance function. That is what the finance department will have these components that they're really going to think about, analyze, okay, and see, okay, the finance, if the company is going to do well or not. Finance is not, if you take accounting, we're really talking about numbers, right? Even finance is all about numbers, but finance goes a step beyond numbers. Finance goes where you're really going to think about finance as something that is so where it has different components, and together it will function to make the company the best, most profitable company that you could have. Okay, so internal functions of finance department. So we have something called the internal and external. Okay, when it comes to finances, we are going to have something called the internal and the external. If I'm going too fast, please let me know. Okay, in finances, the internal functions are simply what happens within. Okay, whether the payroll is processed properly, whether the goods are bought properly, whether the salaries are adequate. Okay, so you have to make sure that the finance also make sure that reimbursements are done. Remember, we were talking about allowances are given, and then we reimbursements, hospitality, make sure the people, different functions that you have inside the finance in the company is at, it's there is enough money for this. It's basically the internal functions of a company. Okay, that is where you're really looking inside the company, and that is one division, a section of the internal function. Okay, you're really looking inside the company, the employees, the providence funds, the electricity bills. All these things are really thought of. Okay, so you are really going to be looking deep into the employees, what they get paid, how are they going to get paid, are they being paid enough, is it is it profitable for them to, is it too much, are they useful, are they stagnant. All these things are going to be thought of. Then, can any of you tell me, Dan, is it possible for you to tell me what external functions are?
Yes, ma'am.
What is an external
External function of finance, madam.
Mm-hmm. Yes.
External function of finance means to budgeting by studying the market.
Yes. So you're looking at the market then, and you're going to buy things. So now say you are into insurance, right? If just because you brought that insurance thing. So if you're
Yes,
into
ma'am.
insurance then you're going to see which is the best insurance to buy.
Yes.
Which are the
Yes, ma'am.
So what is outside of your company? Thank you so much, Dan, for contributing. Right.
Thank you,
So
ma'am.
what is outside of the company, right? So the vendors, the stakeholders, the suppliers, your customers, all these people are external. The external functions are basically how are you going to pay people, how are the banks are going to help you, or how is what are the payment plans you can go for vendors. Okay, so say we are going back into the chocolate one. So then you can say, you know what, I can't pay the whole thing. I'll give you 75%, and the rest of the 25% of the payment I'm going to pay in installments. Okay, so you're going to have deals with your vendors. Some vendors have what you call where you when only you sell the goods that they will pay you. So you will buy the chocolates and you'll say, look, I will only pay you when I sell the chocolates. So it's on consignment basis, what we call. Okay, so you have somebody else's good in your company. So this is what a lot of retail stores do. If you take really big retail stores like Target, they will sometimes, not all the time, it depends on the goods again. What they will do is they will they will take the goods and they will only pay the vendor, the person who gives them, the seller or the vendor or the supplier, only when you get the money. Okay, when they get the money. Now, the external functions of the finance department is also where they have to make sure that the taxes are deducted, taxes are paid, all that we talked about. So if you really think about what we really thought about, it is divided into external and internal. External is taxes, vendors, where you have to, even if you take your pension and things like that, you need to go and give it to so the employee bureau or the employee department or the government department, the bank or something like that. So all that is not within your company. Okay, so if you take this, remember when it comes to external and internal, external is outside, here is external, right? And here is internal. Everything to do with the company is inside the company, from your electricity bill to paying your employees, to everything is internal. And your vendors to taxes to the other things that you have to manage with that is not within your company is external. That is the basic of it. Okay. Treasury functions of a financial department. Okay, treasury is all about foreign exchange payments and ensuring that the corporate does not lose money. So what is it, why do we need the treasury functions? Okay, one of the main things about treasury functions is that when you send things abroad, it goes in dollars, right? So mostly the trade is done in US dollars or pounds or euros. Those are the standard. Of course, it does in others also. I'm not saying it's not, but there are accepted currencies that are there. Okay, so you are going, let's go back to our chocolate buying thing. So you have to say, okay, the Switzerland company says the entire chocolate container is 100,000 euros. So now you can't just send 100,000 euros. You need to go through the treasury, through your bank. The bank will go through the treasury department. So it's very important. Treasury functions is that you need to know how these things are done. That is, how do you deal with other currencies, standardized currencies? This is very important nowadays with globalization. Lots of deals are done through through standardized currency, which is dollars, euros, pounds, things like that. That doesn't mean others don't count, but these are the main currencies that everything, the trading is done. Okay, so it's very important that the finance department has an understanding of what the rates are, how long it's going to take, because sometimes in certain countries, it takes a long time to send the dollars or the pounds. In some countries, it happens within hours and days. Some countries don't accept, they need clearance from one to another. So they need, as a finance department, you need to know how long it's going to take, because if your shipment gets delayed because your payments are delayed, because you don't understand how the treasury functions, then you're really going into a loss, especially if you are waiting for the goods to come to do the manufacturing or to sell it, or is it for some other function? Say you are a wedding planner and you're waiting for these chocolates to come for the wedding that you're planning, okay, or flowers, whatever the thing is. It's very important that this is understood, because if the finance department don't understand it, and the treasury, the payments go for a long time, then what happens is the delay, the products are going to get delayed, and the products coming in delayed means you're at a loss every time. Anything that is coming and it gets delayed, there's a huge loss. So that's the basics of the treasury functions. Okay, and like this says, the most of the time the employees are unaware of the function, since the treasury staff do not sit on an operational office, but instead are based on financial capitals such as New York, London, Mumbai, all that. So basically, some are not aware of what it is about. Okay, and then they are not aware how it's done, and sometimes they deal with, if you're in the stock market, again it becomes an issue. So here are the common functions of the financial department: provide information, manage equity, cash flow. Very important. If you ask me, one of the most important things of of a finance department is to manage the cash flow. Because if you don't manage the cash flow properly, then what happens is everything else goes, other things become difficult to manage. Because if your cash flow inflow and outflow is not managed properly, your bigger, your debt and everything, payments, they becomes an issue. Okay, and that means you have to really, you'll have interest that accumulates. Your taxes can't be paid properly, then you can't pay certain other dividend, no dividends, no bonus, everything is affected. So if you have to pick one very important, if somebody asks what is one of the most important functions of the finance department, first and foremost is the cash flow management, and then rest is provide information, tax management, accounting, external budget preparation, and so on. Okay, so these are the common functions of the financial department: issue business licenses for relevant codes of ordinance for countries, those are very important. Offer, go ahead, Dan.
Madam, can you explain about the risk management, madam?
Yes, go ahead.
Uh, Madam, can you explain the risk management, madam?
You want me to? Of course, Dan. Sorry.
Risk
Definitely. Risk management is that you're going to, what we call risk management, Dan, is whether to invest or not. What is the risk in investing it? Okay. So what you'll take is, if you have a project, right, is it worth the investment? Okay, what is the risk? So every time you start a new project, you're going to have a financial analysis to see whether this money, say you're going to spend $100,000 on this project, and you have to then see how much of revenue you're going to get. Okay, so here the risk management is that you're going to use different formulas, and by using these different formulas you're going to see whether it is worth it or not. And there's also another thing called the risk, is that they have a percentage and said, okay, if it is above this percentage, do not invest. If it's below this percentage, then it's okay to invest. Okay, just depends on different formulas and different ways of looking at it, and they will analyze a whole lot of other things. Basically then the risk management is to see, is the company going to lose money or is the company going to gain money? How long is the company going to take to gain the money? Okay, is it worth that amount of time? Even if you're going to gain it back or you're going to earn a profit, is it worth it? Okay, because it's going to take so long. All this is risk management. Okay, how much of money you lose with if you invest, or how much of money you're going to gain. Is that okay then?
Yes, madam. Yes, madam. Thank you, madam. Thank you.
You're welcome then.
Okay.
Okay, so these are the common functions of more common functions of the financial department. Current fixed asset listing, you're going to make sure that what are the current fixed assets, that is what are the fixed assets you have, like your buildings and your other things. Okay, you're going to take inventory, maintain administrative and financial budgetary controls. Then we are going to making sure about the ownerships of everything, how is the bills paid, reimbursements done. All these are the common functions of the finance department. Okay, apply accurate and timely accounting treatment for county services and activities. So this is very important also. So basically accounting timely, you have to make sure things are in finance, time matters. Okay, because time means profit and loss. Okay, time means in profit and loss is that if you don't do things on time or properly, and if you don't keep up with everything, then what happens is that the profit, you have a loss. If you do it accordingly, you might have a profit. Okay, and if you take too long, maybe the service is not needed or anything. So you're really going to, as a financial department, you need to know what are these things. Okay, again, financial reporting is very important. You need to document. I don't think any other department should document things as much as the financial department documents. Okay, so it's one of the functions is documenting, making financial reports, quarterly reports, monthly budgets, end of month, end of fiscal year. End of fiscal year information means that it just, even though we have January to December, they have something called the financial year. I think it finishes in April or May, if I'm not, no, not May. I think it's end of April, if I'm not mistaken, in some countries. So you're going to, during that time, you need to make all your reports and see what are the profits, what are the loss, what are the taxes. You need to present all these to your stakeholders. You need to do all that, and that is the function of the financial department. During the end of the financial year, if you are a person in the finance department, you will understand it's crazy busy. You're trying to find out everything. You're going to document everything, balance your accounts, make sure that everything is correct. Thank you, Irene. So even in Sri Lanka, it's April. So I think it must be standard, Irene, that it is April. Okay. Thank you so much. The benefits of finance departments, it's endless. Okay, the benefits of finance you have, if you have a big company, even a smaller company, if you have you need to have a finance department, because the finance department is the one that makes sure that the payments come in, control the cost that is going out, make sure that it's warns people that it's spending too much, finds the best prices, make sure that the cost is there, talks about inflation or GDPs, different countries, what's going to happen, what about the treasury, how much should you go, what are these bonds, what are the stocks. All this is done in the finance department. Finance department is a very important department. It's like if you can equate the company to a human body, take the finance department as a heart, because that's where all the blood is pumped, right? You can't live without your heart. Okay, so finance department for a multinational company is the heart. Why? Because it makes sure that things are functioning. This is where the alarm bells go first and foremost. If there's something not working properly in your company, the first department that is going to see it is the finance department, because they will see the profits, the losses, the over expenditures, the what you call it, the obsolete equipment, all these things. This is where it's going to start. This is where they're going to feel it first. Okay, so if you want, this is where everything kind of is seen first and debated about and controlled to make sure the profit is made. Okay, so finance benefits of finance department is huge. So make sure the decisions are proper. Here it says, and you have to make sure that this is where the taxes are paid. This is where your salaries are paid. Okay, if you don't have a proper finance department, your salaries are not paid properly. If you don't pay the salaries properly, what happens? The employees are not happy. You are not happy. Okay, then the work quality drops. Okay, it's natural human tendency. So if you paid properly, if you are controlling budgets and give bonuses and benefits and reimbursements are done properly, then your employees are happy, and then that means you're going to have a good, profitable company, because they are going to put their effort into it. Okay, so for example, if we go into, there was an insurance company which actually looked after their uh, people so well that they were able, this two people, the employees didn't leave that company at all. They were there forever. Okay, so this, and the main function was the finance, because they were paid on time. They were paid their bonuses on time. They were paid their reimbursements on time. So they were very happy. Okay, so these are another thing is, this is where you reduce errors. Finance is where you can't lot, we say to make errors is okay in so many ways, but finance companies are finance departments is something that errors should be minimum, because the errors are very costly. You're talking about millions of dollars. So make sure that finance departments are places where the errors are minimized. For not only the finance, errors are minimized for the whole company. Okay, they are minimized for the whole company. Why? They will see, okay, don't buy thread from here, buy thread from there. Optimize cash flow here, optimize cash from there. Okay, this is better for you, not this. Okay, this software you should invest on, not this software. Even though it looks good, the function is not as good. We don't need the function, like that. So all this is thought of in the finance department based on the price and the product. This is where the price and the product is really thought of. Okay, so that's why they say that lots of things in a company, when things go, first they want something. So you'll have the procurement. You will say, okay, we want this product, this manufacturing or the service department, or we'll say something, we want this product. The sales people will say, yes, we should have this budget. But you come to the finance department, and the head of finance and the finance teams will cut the unnecessary things and make sure that the company sustains and goes according to plan. Okay, and that's where you can measure the growth. Improve compliances and data and financial transparency. That's very important for stakeholders and stockholders, all this, because they need to have data and financial transparency in a finance department, because that's where you really get to see the true picture of the company. Okay, improve productivity. Okay, they definitely improve productivity, improve planning and strategy. And here are definitely different notes about financial management. Few of them are basically They have to structure of debt. They're going to know the use of debt to equity, the magnitude of net income, the management of cash. These are all part of the finance department, no, management. Okay. Another thing we really need to know is cash related cycles. Anyone who would like to tell me about what is cash related cycles? Who would like to tell me about cash related cycles? Cash related cycles are, I'm sorry about, give me a minute. I just need to drink a little bit of water, okay? Sorry about that. Who can tell me what cash related cycles are? Sorelia, go ahead. Sorelia?
Yeah. In my own opinion about this cash-related cycles, by the word cycle alone, we can understand that it's the how to say this, a movement of the cash or the cash flow of, with a certain how to say this cycle, the routine of the cash flow that is moving from day to day, like that is from, for example, in a company, the company to consumer to company, something like that. It's the moving goes on and on and on, like that.
Absolutely. So
Thank you.
moving goes from, thank you so much, Aurelia. Okay, so it goes from how the cash is coming in and going out. Okay,
Yeah.
that's basically the basic of it. Okay, so there is two types of cycles. Okay, the operating cycle and the financing cycles. Yes, Dan, go ahead. Dan?
Yes, madam. The cash related cycling means like in stocks before we are using people, no, man. Fast in, fast out. So
Yes.
yes, madam.
So
So likewise, yes, madam. Likewise, to roll fast, madam.
yes. So how do you go from one to another, right? Definitely. So we have two things called. Thank you so much, Dan. The operating cycle and the uh, finance cycle. Operating is basically everyday Marivik, do you want to go ahead? Marivik?
What I understand in cash flow is it's like in my field, always have we call it petty cash.
Yes, absolutely. But we have petty cash. So that is what
Yeah,
operating cycle is about, right? Very good example.
yes, we call it petty cash. Like for example, I have a budget, a specific budget in each department. So I'm
Yes.
giving them a budget. I'm giving them a budget each department. Then I will know the daily usage
Yes,
and which department is high, so I can monitor the cash flow, the cycle of my finance, like that.
absolutely. That is the basically operation. That is a very good example of the operating cycle. The petty cash. Thank you so much, Marivik. Right, that is actually a very important part of the cash inflow. So petty cash is something that you use the cash to buy small things, or the cash that is there per day to use as spending in your department, right? But what is the finance cycling is the product and services revenue you get. So it's here is operating day-to-day petty cash, like Marivik said, absolutely correct. Operating a finance cycle, products and services provides revenue, but usually in the form of accounts receivable and how you collect cash. It's the bigger picture. It's the bigger picture of making a profit, like, spending money and things like that. Okay, so for day-to-day versus profit, loss, all that is other one. Now we have financial accounting versus financial management. Okay, so financial, when the moment you put accounting, it's all about debits and credits and things like that. Okay, it's about how much has come in, that is credited, how much is debited, that is what is going out, and in the process, how much is the value of a good that will add the value to the companies. So even if you have a building, how much is this building worth, and that will go to your assets, and that will go into your financial accounting document. Financial management is the overall management of the finance. Okay, that is the basic difference between it. Financial accounting versus financial management is accounting. Think purely, for now, you just have to think of debit and credit. That is things that come in and going out purely in terms of where in numbers, whereas financial management is where you're making sure that the entire company flourishes very well. Here you're keeping books, it's in your book. Okay, 10,000 has come in from the from your manager, or no, sorry, from your customer, but 5,000 has gone off, and this is what your profit is. Then you will look at your net profits. All that is done in financial accounting. Financial management is where your risk analysis comes in, your whether you should buy dividends and pay dividends or not. All this is financial management. Okay, debt structure, it's very important for a company. Debt structure is basically where you have the management maximum in conjunction with financial cycle to manage the debt. How do you manage to pay the debt? Okay, that's also from the debt structure is what we call the leverage. That is, how are you going to manage to pay your debt? Leverage is how much are you going to manage your to pay your debt. Or yes, okay, if you need to say something, please go ahead. Okay, if you have a comment. Okay, because of the time factor, I'm just going to go keep going on. But if there's anyone who wants to tell anything, please feel free. So leverage can be defined as leverage equals asset divided by equity. Basically is a use of debt and how the organization can buy things, and also they have to see how they are going to be able to pay it back. Okay, it's as simple. So all these will have names and things like that, but the root of it or the base of it is very simple. Okay, so we have the advantages of leverage is leverage allows the organization to own more assets than would be possible if it relies only on its equity. Okay, so here it's all about, like we said, it's about the debt. Okay, so debt, that is the use of debt. How are you going to use the debt? How are you going to manage it? How are you going to pay? How much can you get? All that is leverage. Leverage is you're going to, now if you just rely on your profits alone, it's not going to work, right? If you're going to just pull out your profit, then your cash flow can get in. Then what happens is you have leverage. That means you're going to take, how if you can manage the debt, you're going to make sure that you can grow with a certain amount of debt. Okay, that is, you're going to be able to grow your company. Rosalind, is there anything you want to say, Rosalind? Then you have the drawbacks. So debt is not always a friend and debt is not always your enemy, right? So drawbacks of leverage is that you need to know how much you borrow and how are you going to pay it back. Is your company going to earn enough from the to pay it back? Okay, so the advantage is that you're able to earn more assets, you're able to use more of your really give more and maybe double your profits because of this leverage. But At the same time, the drawback of leverage is where you need to be able to pay it back. It's like the condo, right? If you're unable to pay, the debt helps buy the condo, but if you're unable to pay, then it goes back to the bank and it's a huge loss, okay? Or goes back to the person who has taken this. So that has to be really thought of when it comes to the debt factor, okay? Then we have the then we have the financial risk versus business risk. Financial risk is basically profits, losses, and things like that. Business risk is basically, uh, so no, sorry, my mistake, the other way around. Okay. Finance risk is how are you going to manage your debt. Business risk is whether your cash flows and your profits and losses are there. So financial risk is how you're going to manage your debt. What is your debt factor? How much is that going to happen? And then the business risk is basically how an organization's annual cash flow really, whether it's a profit or a loss, the revenues, all that is business risk. How much of risk is it going to take? Okay. So here is case study 1. Okay. Let me see just a quick time. Okay. We are going to do a couple of there's 3 case studies. Okay, and there's additional reading for you. If you have any questions, if you have any explanation, if you need any explanations, if you need questions or anything, if you have any questions, if I went too fast and you couldn't understand anything, I will put my phone number at the on the text, this thing, and you're welcome to send me a text and I'll try my best to answer it the best way I can, okay? So here, let me just go through it. And in another 5 minutes, I'm going to upload the poll for you, okay? So here it is. Goodyear tires and case study 3 is in 1990, after suffering its first loss in half a century, Goodyear Tires and Rubber Co. reduced its dividends by a total of 8 million. So remember, dividends is what you pay outside, okay, to your stakeholders and stock shareholders and all these things. It also began to limit capital expenditure, so its cash flow from operations would be sufficient to handle basic needs. According to an article in Business Week, that cash won't stretch far enough to pay off much of Goodyear's 3.6 million in debt. As a result, Goodyear decided to try to negotiate an extension of its 2.24 billion revenue credit line. That is short-term borrowing. They are trying to extend it. Okay. As you can see, here they wanted to reduce the dividends because they were at a loss, okay, and they couldn't afford to pay it as much. And then they decided to go and they wanted to extend it to 2.25 billion revenue credit line, that is short-term borrowing, so they could really bring up their business. Okay, so what has happened? Let's see. According to the lender quoted in the article, however, they have a big chunk of debt. It's out of proportion to the cash flow. Now, this is where the finance department really needs to do something. Why? Because if the debt is so much more than the cash inflow, let's talk about it as inflow, then it's really not going to work properly. Okay, how are they then? The banks and everything is going to see how are they going to support this debt? Are they able to pay it? Okay, these are all questions that are going to be coming in. Okay, so you got to do something about that in rather short period of time, because this is a short-term loan. Can you see? As a result, there was a possibility that Goodyear would begin to sell off some of its assets. So how are they going to make it up? They're going to sell off its assets to raise cash to reduce the debt burden. That happens to many companies. Okay, so they will sell their assets depending on the machinery, maybe land, maybe cars, maybe whatever the assets they have. In effect, by using short-term debt to finance fixed assets, Goodyear has a financing mismatch. So the finance department really has not really done the work according to this article properly, because it's not matching. They're asking for a debt extension. Their debt is outweighing their cash flow, and because of that it's becoming an issue. Okay, so that is one of the case studies. And the case study 2, I'll quickly go through this also, is where the Progressive Grocer, quoted of a chairman of a Safeway store, includes with interest rates of less than 10%, it does not pay to cut back on capital expenditure to reduce debt, because the rate of return is 25% on new stores and 30% on remodels. The article went on to say that the high leverage climate has resulted in some new ways of looking at financial figures. In particular, 3 factors were discussed at that govern the success of leverage firms: the business environment, how well the company is operated. So here are the 3 factors. In this case study, they're talking about the debt they're going to acquire and how they're going to address it. Okay, so here they're basing it on 3 factors. Okay, and that's how they were talking about how the governance of these leverage firms work. The business environment matters a lot. How well the company is operated matters a lot. The ability to spend the money on capital improvement. So as you can see, they're really looking into what the business is about, how the company is operated. That is it viable, the company is operated? Is it a good way? And finally, is the capital they're going to buy is going to improve? See, these are all functions of the finance department. It's a finance management in a company which will make or break the company. Okay, so with that, we have come to the end of the lecture. These are all that is there. You can read it. And now we are going to go into the poll. Okay,